Welcome to another video. My name is Robin. As per usual, I'm joined by Karu, and today we have something juicy for you. It's not the first time that we talked about Nvidia. We have talked about Nvidia extensively in the past. But of course, when news like this hits the fan, you just have to talk about it. So, what's in the news? Nvidia's business is growing faster than expected, but investors are still disappointed. And Kirill, see, this is what happens when you have an overvalued stock and you can't live up to the hype, and there's so much riding on it, and you're just growing really fast, but you can't please everyone if your valuation is so bloated.
Yeah, at this point it's just hysterical, to be honest, because as Robin said, the results of Nvidia, the quarter results were good. You cannot say that they performed below the expectations, but the street have set the expectations even higher, so that's why the stock went down 8% yesterday. And at this point, the question is like, okay, is it the question of valuation? Is it the question of some GameStop kind of movements already going on the whole street, or what? So it's probably just good again just to revisit Nvidia once again, and maybe just answer the question: what's the value? How much does it
Exactly.
cost? Why does it jump up and down 8% like crazy? So yeah, shall we
Yeah,
get to it?
let's get into it. So, of course, at this point, as you are used from us, we're going to give you four things in this video. So, what's in the news? But we already covered that. The fundamentals of Nvidia, the important ratios, and finally, we're going to leave you with a valuation of Nvidia. Of course, as per usual, not financial advice, do your own due diligence, but at least that's a starting point for your future endeavors with Nvidia, and that's the value that we're going to give you in this video today. So, Kirill, let's go over the fundamentals.
Yes, sir. Um, so as you can see, you can clearly see some very good numbers, right? Of course, the market cap of $2.66 trillion, that looks insane, of course. But been there, done that. We have seen that for quite a while already. Observing Nvidia. But is it justifiable? Because let's say the P ratio of 60, of course, with such crazy growth rates of, let's say, 47% over the past 8 years. Yeah, of course, it's insane. The free cash flow growth over 100%, that's even more crazy, right? But you can also see the good part about the margins, right? Because the gross margins of almost 80%, this is very healthy, even though we're in the hardware business, right? And the operating margins are also quite healthy. I would say even quite great, because 65% is not that many, technology companies can get these kind of results. That's good to see,
Yeah.
right?
Exactly. What I'm noticing immediately is that the PE ratio is at 60. I just looked up what the semiconductor business is doing at the moment, and the average PE is 35. So it's almost double the PE ratio of the industry, which is already quite extensively overvalued, right? Normally. So that's one thing you have to keep in mind. If you, for example, follow Peter Lynch's advice, he would say something like, yeah, make sure that the PE is in line with the growth rate, and you can clearly see it's not. So these can already be indicators that it might be overvalued. Um, and yeah, we can just continue. But like you said, Kirill, like the average revenue growth, it's good. Like green check marks all the way,
Yep.
and yeah, good margins. So that's
Yep.
like it's not a shit company. Just you need to know if there's like yeah
Is
if the
it is
value
it
is
worth
justifiable.
is it worth paying the double for it exactly in comparison to the industry average? But you can already, of course, everyone knows that it's a leader, it's a true leader, right? In terms of like providing the chips for the AI, right? Computations. It's one of the best for example, doing the computations for the servers, right? Like you don't have that many options. So it's either Nvidia or AMD, right? And more people just lean towards Nvidia. And of course, the gaming part, right? Everyone wants to have some juicy performance on their games, and that's how they make money. Yeah, it sounds pretty straightforward. It sounds great. It sounds like a very well managed company at the moment that's just a little bit too expensive, at least when it gets to this kind of indicators, right? That we're looking at.
Yeah. Okay. So next we're gonna go into the important ratios of Nvidia. I think here you see things that, of course, correlate with each other. So revenue is growing, therefore gross profit is growing.
Yeah.
We can see that research and development is growing, which is something that you, of course, want to see. But we're going to dive deeper into what's the ratio of the research and development, and is it not out of whack? So yeah, for me, this looks pretty good. I think we
Yeah.
can continue.
Yeah. And also maybe just to highlight, let's say the interest expense in here is rather low, right? Especially in comparison to revenue or even gross profit. And research, like R&D expenses, they're also not that high. But we can also check the ratio real quick. We can probably skip the free cash flow. We've already seen that, skimming through. Only thing is probably the long-term debt is 5.5 billion at the moment, but they can easily afford to close it in a year probably if they want to. But then again, probably they started loading up on that debt during the COVID times, so the interest rate on that debt is quite low, presumably. So it's kind of like a helicopter money still Nvidia has. So I don't see any red flags in here, at least. Yeah. But yeah, if we for example look at the R&D ratio, that's not bad, right? So on average it's 30%, but for the past 2 years it's 20 and 16 even.
That's good.
Yeah.
See, because normally we would look into companies, or at least for us, what we're looking at is like around 20% R&D, and for example tech, of course, it's really difficult because you need to invest because the industry keeps on evolving. But companies that have like a low research and development ratio in tech is, for example, Apple. And what's good to know about, if you don't have to spend a lot of money into R&D, you have some kind of a moat that people want to pay the price for the product, even though you're not developing. And that's could signal a really strong company. But here you see that, of course, in the past years, they haven't been developing as much. Could be different factors, right? So one thing could be people just buy Nvidia because it's Nvidia. Other thing could be that the hardware industry is not evolving as much.
Yeah, and also, for example, it's the competition is not that solid, right? Because there are big players. For example, you got AMD and Intel and, for example, Micron and so on and so forth. But in order for newcomers to actually, get in with greatest product and start penetrating market so easily, it's hard. So you could say that Nvidia has definitely good moat around itself. So that's definitely good to see. And if we also check, for example, the other, indication of a good moat, such as selling in general expense ratio, it's also going down after 2022. So it's 19% and 15%. So that's also great. Yeah. Honestly, that's great to see.
Exactly. So this also means that they are able to sell and market their product. Or at least they sell the product without extensively need to marketing them. So it's a product that pretty much sells itself.
Yeah, exactly. And and the only thing is, which is a little bit of a red flag, is having a little bit of the share dilution. So they actually, issue more shares, but it's also quite a marginal amount. And also on top of that, Nvidia has announced yesterday that a share buyback of $15 billion. So that also means that the company is actually going to probably focus more on the shareholder part, because we also started issuing the dividends recently. So they will also try to, normalize the aspect of the shareholder management, let's say. So issuing more dividends and having less shares in circulation. So that's, again, surprisingly, it's a good science, right? That's the only thing I see.
Yeah, exactly. That all sounds really good. So that's also the point that we're trying to make, and also in our previous videos, like it's not about company, but we just need to see whether the valuation keeps up. Yeah. So okay, let's continue. Shall we go into the valuation, or is anything else that we need to look at here?
Yeah, I think the only thing is what to keep in mind for is just the maybe the reduced revenue and free cash flow growth opportunities, right? Because it's, of course the company is growing with some crazy percentages, right, over the past 8 years, sure. The only question is just also to keep in mind when we're going to go for valuation part is that to what extent is it still possible to grow with such extent, So, for example, for 2024, it's already being considerably less revenue growth, right? So can we assume that the similar pattern is going to be also occurring in the future? Probably yes, because if we go to the valuation part of things, currently it's free cash flow is 27 billion. If the company would be growing that with, I don't know, 20% every year, oh my god, that's probably the best business you can imagine in the whole world, in the whole universe, probably. But realistically, is it possible? Yeah, questionable. It's rather questionable. Thing.
Yeah, and of course you have also seen this with Apple, right? In a previous video, that you cannot sustain this growth forever. At one point, it just tapers off, and you have to accept that either buy more businesses to go into other businesses, or just be a cash cow. But then also that should reflect, in a sense, your your valuation.
Yeah, exactly.
All right.
Yeah. Shall we
Talking
get in?
about valuations,
Yeah, off
let's
you
get
go.
into it. So of course we start with the free cash flow starting point, and it's something that you can adjust yourself, but we always keep it on the previous year. So the projected period, I would say for this kind of volatile industry, you see it now as well, like with swings of like 3 and 7%, and the developments, new competition coming in. I would say right at 2 to 5 years, you never know what's going to happen in this short time span.
Yeah, I would also say five is realistic, but then we can also play around with the assumptions a little bit later, and let's see.
So the discount rate, we always keep this at 10%, but of course feel free later when this web app is available to play with it around yourself. The estimated growth rate. So they say that in the past 5 years they've been growing with 31%, which is quite hefty. The average free cash flow growth has been 45, which is also hefty, which is like an average of like 35%. But I was looking into what the analysts think, and they at Yahoo Finance they say for the next 5 years per year they're gonna grow at 52%. And this is also why you see, this is why people are gonna be disappointed. They're gonna buy in on the 52% premise of growth. Of course, it's not gonna happen. Like you can look at the data now, what it's doing for this year. There's no way that they're gonna grow with another 52%. So I would be generous and give them maybe 25%.
Yeah, that would be, but also keep in mind for the upcoming 5 years. So we already have seen, right, then when the interest rates went up, the hardware, I could not call Nvidia's hardware cheap, right? Even though there's like AI demand for the infrastructure and so on and so forth, people would have a little bit of tough times to spend a good buck on such expensive hardware, because this is best in the class, right? So this is kind of like, you can call it like Apple of semiconductors, of chips, right? When the interests are gonna go down, as we discussed in our previous video, people are gonna probably experience a little bit of recessionary environment, right? So that situation will still happen for at least maybe now or another half a year, right? So what's gonna happen after that? 25% a year, even that would be a little bit too hard. But shall we do maybe 15 just to start with and see? Maybe it's already gonna show some good results.
That's something that we can maybe look into in our time career, but we also, and also this is for you, for your due diligence at home, right? So is Nvidia's clientele more business or is it more consumer focused? And that's something to also figure out, because then you also know to what extent is this growth, scalable. So if it's businesses and with the whole AI industry, starting up, then a higher growth rate might be justifiable. But if it's mainly consumers, then you have to look into like, okay, what can they do? Like you said, Korea with high price and all that.
Yep.
So for the PE ratio, so the industry average is 37, right?
Mm-hmm.
I would just put that. I think the 55 PE ratio for the past 5 years is really high. I'm not sure. What do you think?
Also, if we assume that the revenue growth would I would say it's not going to decrease, it's going to normalize. This is actually quite a healthy double-digit growth per year. Then, of course, the PE would probably also go more or less to the industry average. Maybe we can just also give it a bit of a discount and say, okay, it's still the industry leader. Maybe it's going to have a little bit higher PE than its peers. So 45 tops, really. Even 40 is quite good. Like I would not be buying probably stocks when they're at 40p unless they have very great growth prospects and they have great moat. That's probably the case with Nvidia, but we can check later.
Yeah, and then the required rate of return, we normally put this at 12%, right? Because when you're stock picking, you have a bit more risk, and if you could otherwise buy an ETF and have 7 to 10% returns annually. So because of the added risk, you want to have a bit of a incentive. So therefore 12%. But of course you can play this with yourself if you really want to have not per se risky bets, but you want to have a really high rate of return, you can always put this in. But of course, the chances that you're going to find an undervalued company is of course always a bit lower. And the margin of safety, look, I would put this here around 30-40%. It's highly volatile. It's a really complicated business. There's a lot happening in a short time span. But of course, if you know a lot about semiconductors, feel free to put this down to like maybe 10%, right? But I think for your mid 30% will be healthy.
Yeah, and I think also not only it's a question of knowledge, but it's also about the question of volatility. Because some
Mm-hmm.
investors, they actually enjoy the volatile times, and then they do like day trading and this kind of thing. Yeah, Nvidia is probably one of the best conventional stocks out there for that purpose, most likely. But if you're there for more like okay long term kind of focus, then yeah, this is probably a little bit more risky bet for you. So yeah, I agree. 50 is a good number. Yeah.
All right, and then we press the analyze button.
Yes.
Well,
Looks interesting, huh?
it looks interesting, but we can also see where that's coming from, and that's coming from the intrinsic NPV formula. It's giving 1200 a valuation of 1200, which is difficult to believe, to be honest. But that's just because it's due to the high PE ratio and high growth prospects.
Yeah. Because if we, for example, take the target valuation formula and Ben and Graham's one, that's that's realistic. That's realistic. And surprisingly enough, I was also when there was a big slump of stocks. I think it was around a month ago, in the beginning of the month of August. I was actually targeting to get Nvidia around $85 to $90, when it get to that, but it didn't. I think it went down to around 95, so almost got it. But yeah, honestly, I feel like it's an expensive company, but you also can clearly see what you're paying for, right? So you pay for the moat, you pay for great business. They're also quite good at finding the growth opportunities. Even for example with AI, they jumped on it quite quickly, right? Yeah, of course, the only question is the risk part, right? The growth prospects, and yeah, for how long they can maintain this dominance, right? So maybe having a little bit of margin of safety there is not going to hurt. Yeah.
Exactly. All right, and with that said, we covered everything that we wanted to cover in this video. And of course, if you want to get this web app, it's not available yet, but make sure to subscribe and follow us on our social media channels so that you know when we are launching the web app, and it's not gonna take very much longer, but we're just streamlining the whole app to give you a better experience. Again, with that said, Crew, thank you as per usual for being here, and we'll see you guys in the next video.